We will start today's session. And in today's session, what can you see my screen? Yeah, can you all see my screen?
Yes, sir.
Okay, so in today's session, what we will do, we will try to discuss basics of a derivative market, why it is important, what kind of instruments are available, especially if you want to trade in India, how you can trade, what are various aspects, because this is a kind of course that you will be learning in your financial risk management or in your derivatives, because this is separate stream of finance. Like we have one stream of finance which is related to corporate finance, and there we talk about how companies function, how they raise capital. So when it comes to capital raising activity, capital market is going to be play important role. Then how they raise capital through debt instrument, through equity. So there are n number of different sub streams. So, but our objective in this course is to know at least basics of those streams, so that when you start taking any online course or any course offered by a faculty member in coming semester, you are going to have some background, and with that background you will be able to do well when you go into each and every instrument and examine why that instrument is unique, how it can be used for various activities, whether it's hedging, whether it's risk mitigating strategies. So all those expertise you will get when you get into those courses, those details. So we will start today's session. I believe around 19 students are online. So with that, we will go ahead. And before we start, I would like to know how many of you have some kind of background related to derivatives. Can you all raise your hand? Because if you have understanding, then we will be able to go and for a little bit quicker pace, otherwise we'll move forward slowly. I believe yeah, I can't see anyone who has raised their hand. It means this is a relatively very new domain for most of you. So what we'll go, we will go with the slowest possible way, so that you will be able to understand the importance of derivative market. So by name itself, you can make some sense. Basically, this is something, derivative means somewhere value is going to be derived, and where these values are going to be derived is basically instrument that are available, that we can observe how their prices are going up, going down, and based on that we are going to determine about derivative market. So let's first look at the history. Even in past time also, we had a kind of setup. For example, when someone in very old time, if we go, especially when we had barter system. In barter system, let's say someone having let's say wheat, and someone wants to exchange with other product, or some kind of, let's say, wheat, and then here let's say rice is there. So when there were no currency, but there was a kind of mechanism by which value of these instrument can be derived. Means there was some mechanism by which these values can be exchanged. So if someone having wheat and require rice, so considering this kind of setup, so of course there were no currency, even there were no currency, but this kind of setup was there. So it means in history, of course, there were no well-structured market, but this setup. Another setup that we can think of, let's say, you require, let's say, 10,000 kgs of or 100 kgs of, let's say, some kind of, let's say, uh, you know, your some kind of pulse in a year. So this is what your requirements are. You know that this is what you need, and if you think that when it comes to high demand season or off season, the prices of this particular item goes up, or over the period of sometime you have seen prices are going up. So you can come with some kind of agreement with the farmer that you would like to buy this much amount of pulse from the farmer when he is going to produce. So you both are going to get into some kind of contract where this much amount at preset price, let's say price of this we assume is, sorry, 100 rupee per kg. So this into this, and then assuming that this is the lot size or size that farmer would like to trade, minimum would like to trade with you, you both get into the contract. So if we compare these two type of market we already had, whether any pre physical exchange was there or some other form. So your derivative market basically is from this kind of setup, which was not formal, but later on people realized that we need this kind of market. So we'll see various type of contract, various type of instrument. But let's first look at the history. So when it comes to three type of market, three type of instrument in derivative market, you will find one is forward contract, forward contract or agreement. Second is futures contract, and third is options. These are in general you will find options contract. And then later on, various other contracts came, like swaps. So there are variety of options. But when we talk about derivative, you will find we will start our discussion with these instruments. And there are certain differences. So we'll look at their differences later. So the first exchange that we talk about, which is well-structured exchange, is Chicago Board Option Exchange, which was officially started, uh, it is, in 1972. It started basically 1948, and it started, trading of futures. But in 1972, options were introduced. So you can see, there were various stages or various landmarks. And further, when we talk about options on currency, like this is option on equity, because option is a kind of what you call a tool, or what some kind of mechanism by which assets can be traded. When it comes to asset class, option could be stock or equity, Option or instrument could be currency, or option could be some kind of commodity. So your these are basically these encircled items are basically your assets or asset class, and these assets class are traded as option in various market. For example, let's say in equity, we call equity. So equity is a kind of overall, you can think of, a general basket. Within that, you may have different asset class. You can have Reliance Petroleum Industry. You can have Tata Steel. So, but in general, when you are defining equity or equity characteristics, these characteristics are going to define based on class, the broad class equity. Same way, when you various terminology that we use, so this is basically one kind of a tool like equity. Same way, you have various asset class, and within asset class, you have different instrument based on specific requirement. And also exchange traded options. So it started with futures, then equity were introduced, and then exchange traded option, and then interest rate option. So basically here, how options market evolve over the period of time. So it's, history is very long. If somebody wants to read, go and read, you can get, n number of sources. But the one of the best book that I have found when we talk about derivatives is John C. Hull. Means globally this HULL. So globally, if you want to read more about derivatives or these instruments, this book is really going to help you. This is very easy written, and you can easily relate with your these contexts. When it comes to Indian derivative market, basically in Indian derivative market, these are landmarks. So on NSE was the first that introduced index futures. So in 2000 it was introduced. So index future means your asset class is basically some kind of index. Tool is futures, but asset class is index. Same way, here in 2001, index options were introduced. So to asset is index, particular index, and tool is your options. And then stock options were introduced in July 2nd, and then single stock futures were introduced in 2001. So basically these are certain landmarks. So you can see when we compared with US market with Indian market, almost 32 years we are behind. So they were 30 years ahead. Why ahead? Because they've in US people already most of the industrial evolution that happened in US, or the way all the market expanded, developed market majorly were ahead than other markets. But we are now globally, if you go and look at in terms of global trading, NSE stand third in terms of this kind of derivative market in terms of trading. So we have, we are not far behind. Of course, these instruments were introduced late, but now we are doing, good. Now, when it comes to derivative, so what we mean by derivative? Basically, when we say derivative agreement, so this is an agreement between two parties to exchange a standard quantity of asset at predetermined price at specified date in future. So basically, these are a kind of derivative instrument. the value of these instruments like index derivative, index futures. So index could be Nifty. We have examples, so we'll see. So Nifty is basically index. So the value of this derivative will be function of Nifty. But this is basically a derivative product on which you can trade, and this is a kind of futures tool or future option, future future what you call tool that you'll be using. Another definition that we may come across about derivative, basically derivatives are financial instruments or security, and financial are and derivatives are financial security and are financial contract that obtain value from something else. As we have said that here, when we talk about index future could be Nifty futures. Basically, Nifty is an index, so your value is going to be derived from how value of Nifty index is going to be there in the market. So financial contract that obtains value from something else known as underlying security. Underlying security may be stock, currency, commodity, bond, or other type of assets. And it means asset is available, so you can have two positions. You can go and buy these instruments, or if you have these instruments, you can sell. So in derivative market, generally we use term long position and short position. So when we say long position means counterparty is counterparty or party or like individual who is in taking contract or agreement to buy. Means you are going to buy certain instrument. When you are going to buy means you are taking a long position. And when someone is taking contract to sell, it means taking a short position. So generally these are terms we use in the market. Now if you think about our earlier first example where one you or someone is writing a contract or making some kind of agreement with farmer to buy pulses, 100 kg of pulses. So now in that case, if you see, because in market, based on demand and supply schedule, price of those pulses or those asset commodity, you can call in general commodity, may go up or go down. So it means, and similarly, when you are taking some kind of currency based instrument or currency based derivative instrument for hedging your risk, it means you want to basically minimize certain kind of risk. So in general, what we observe, these three type of risk whenever we involve in any kind of trading. In case of pulse, or when all your your instrument is being traded in single economy within you know uh, uh, within a country's boundary, so market risk will always be there, because based on the market, price of asset may go up, go down. If it is a stock, we have seen that when how people trade in the market with sentiment or with some prior information. So market risk we cannot avoid. Whatever best you do, you can only avoid stock specific risk or asset specific risk. Market specific risk will always be there. So derivative market helps you to minimize these risks or to hedge market risk. Similarly, you think of interest rate risk. When we talk about interest rate swaps, interest rate swaps, there you will find that because there is a risk of movement in the interest rate. And that's why that risk may affect your portfolio or may affect your wealth, because ultimately you have created one portfolio or you have investment in different instruments or asset classes. So because of change in the interest rate you may be affected. Or in the bond valuation, we have also seen how change in interest rate may affect your holding value or your wealth. Apart from that, when we think about international or global market, always exchange rate risk is there. Means you think about a scenario where you are exporting certain goods from US to India, from US to India, US to India, and assuming that the total wealth of goods that being exported is 1 million, and if the dollar and value conversion rate is, let's say, 75 rupee per dollar, it means the worth of this currency, this goods exported from US to India is around 75 million INR. Now, if the rupee value appreciate, let's say it comes down to 70. Let's say the importer takes 6 months to pay back to the supplier or exporter. So in that case, in 6 months, if price of this exchange rate Indian rupee appreciates with respect to USD, then there is a risk that there will be loss of around 5 million INR to the exporter. So to avoid that risk, certain instruments are available, like foreign currency based instrument. So what will happen? This US firm will be able to hedge or able to minimize the risk because of undesired fluctuation in the exchange rate. And that's how your these instruments are introduced. And if you look at, when we are going to talk about each and every instrument, you will find that their application is numerous. It could be because to avoid exchange rate risk. You will also find very much instrumental in minimizing the market risk. So that's how these new instruments were introduced. And across market, you will see majorly you can classify whether it's forward, it is future, or it is option market or option instrument. But in every market you may find different type of as instrument. Why? Because requirements are different. In US there may be requirement for some specific instrument, but in India we don't see requirement. So based on requirement also, you will find different type of instruments available in US versus in India versus some other countries. So there are these type of instrument you will find equity derivatives, interest rate derivative, as we have seen to avoid this kind of risk, currency derivative whenever you have this kind of risks are there. So based on these when you identify these risks, it means there should be some mechanism to minimize those risks, and that's why instruments are available. So the major application, or majorly most of the firms use these derivative instruments to hedge their risk. Risk, we have seen three types of major risk, and that's why they try to minimize those risks by taking these derivative in the market. Apart from that, these derivatives also are major source of information. And why, if you go and read article, you will find there is lead lag relationship between spot market and futures market. You just type in Google, you will find lots of studies out there. Why? Because when you are because there are various, like in our example where you are planning to buy 100 kg of pulse from a farmer, and you are saying that I am going to buy after 6 months when you are ready with the produce. So it means you are speculating, or you are, because I'm assuming that you have certain information about future prices of pulses. So with your speculation, you are you know you are getting into a contract or agreement with the farmer. It means it is a kind of future, or future a source of future information. Your information may be correct, whether pulse price may go up or may go down, but when you are getting into contract, it is assume that farmer thinks that he will be able to save his time going into the markets, identifying the potential buyer, and he's also getting some upfront money, let's say some kind of payment from you to purchase 100 kg of pulses. So in that way, if you see, these markets are a source of information. And also because people are buying and selling these instruments, so it enhances the liquidity. And also for portfolio manager, or people who are creating, they want to achieve the best possible portfolio, these instruments can be very useful, because one way they can hedge their risk, at the same time they can go for taking higher risk, hedging risk and taking more risk. So in that way it helps portfolio manager or portfolio creator to think of various ways by which they can optimize their portfolio. And also it allows portfolio diversification. So these are various benefit that we can see. Now when it comes to a market, so like as we have just discussed, that forward, future, option, these are basically market where you will find various instruments are available. So what these markets are? So first we will talk about spot market. So by name itself, what we are referring is to current or spot condition. So when we talk about spot contract, is basically an agreement made between two individuals. These two individuals are basically buyer and seller. At time is equal to 0 at present, for the seller to deliver the asset immediately. Means this is a kind of a spot market, you can think, where buyer and seller are, one is buying, another is getting that asset, and buyer to pay for the asset immediately. And when we are saying forward contract, by name itself we are saying there is some kind of agreement which will be active, or which is going to be exercised in forward. So what does it mean? Basically an agreement between buyer and seller at t is equal to 0 to exchange a non-standardized asset for cash at some time in future. And details of assets and price to be paid for forward contract expiration date are set a time. It means your buyer and seller are, let's say this is t is equal to some t, and at this point of time buyer and seller, they are negotiating with each other to buy certain goods at a price dollar in future. And whatever asset or goods they are going to buy or sell, are going to exchange in future is non-standardized. Means quality is not assured, or contract is not very much, framed or very much standard. So you can think of, various cases where, when these two buyer and seller are executing, because products are non-standard and contract is also very much customized. So chances are very likely that there will be deviation between what was promised at t is equal to 0 and what is realized at t is equal to t when it is being exercised. So to avoid these kind of problems, and of course, when someone is buying contract, certain payment will be involved. So that is already there, whatever instrument we think of. So to avoid this kind of non-standard standardization of asset, future contracts or future markets was introduced. So in future market, the main difference is in terms of standardizing the asset and various specification of agreement. So in futures contract, agreement between buyer and seller at t is equal to 0, like forward, to exchange a standardized asset. Now you know that what kind of item, what kind of product you will get when this time comes at t is equal to t. In exchange for cash for future some future date, each contract has a standardized expiration and transaction occurs in centralized market. Because everything is standardized, then it is possible that it can be traded in a central market or market like NSE or exchange that we see. So this is the major difference between futures and forward contract, and this is what we have just discussed, that how it will take place. So as we know that generally these tools are used for hedging. So similarly, forward contract, in our example, we have seen that these can hedge risk up to large extent. And using open forward contract or flexible, because contracts are not standardized. So in forward contract, so it can be customized based on the uh, you know uh, opinion of both parties involved in writing the contract. And using market contract with market order. So in that way you can see that forward contract can be very much useful. And also these are a non-standard contract, so no requirement of NSE or BSE kind of exchange. In OTC market also you can see the trading for contract, this kind of forward contract takes place. But there is a counterparty risk, as we have seen. There is no exchange, there is no standard specification of agreement or asset type, and that's why there is a risk. So already know we have already seen that your forward contract is basically a non-standard contract. Now coming to futures, so in futures contract, basically these are standardized contract between buyer and seller, with which fix the term of exchange, price, quantity, or lot size, and that will take place then at some future date. A future contract, basically a legally binding agreement between between buyer and seller. So major type of major types of future contracts that we see in India in stock index future, interest rate future, and currency futures. Now, this graph tells how futures market evolve in India. You can see, it's continuously having, upward growth. So that's why we have, various scope for futures market. And here, when we talk about future market, we should know certain terms. For example, lot size. So by name itself, lot size means there will be a fixed minimum, size that will be used when you buy and sell. For example, when we talk about Reliance Industry, so this is means the asset is Reliance Industry stock. So this is basically if major a broad class I write, this is stock futures. But stock, the asset, underlying asset is what? Underlying asset is Reliance Industry Limited share price. So in this lot size is 250. It means when you go and see how much money you will have to pay, or the lot size, 1 unit basically of futures contract of Reliance Industry futures will be of 250 shares. Similarly, for State Bank, 3000, and when we talk about Nifty future, it could be 75 shares. Means these two are basically what? This is stock. This is you can think of bank futures, and this is index futures. Now, second term that you may come across is futures price. Basically, this is the price of contract when you are at which you are going to trade. For example, this if we look at the definition, the price of future contract track the price. So this is basically your price of one future contract of Reliance Industry. So this is we define it based on lot size. Your future contract value is going to be decided. Other terms like contract value. Contract value will be basically your how much, like 250 shares you can buy, and if lot size is 250 and you buy one Reliance future contract, so this much amount basically you will have to put to get into the contract. Similarly, when we talk about expiry date, means date when your contract is going to expire. So this is basically T is equal to T, small t. So small t is nothing but your expiry date. And generally, whenever we discuss about futures contract, you will come across three, for each future contract, you will come across three expiry date. This is near, we call it current month or near month. This is, we call it next month, and this is, we call it far month. So near month. So these terms you may come across, or current month. This is next month, and this is far month contract. So three contracts will be available, at given point of time. So here you see I have taken example. So underline is 2600. This is today's information, and this information, if you look at, this is I think previous March 2021 information. So there may be some differences, especially in number, but majorly you will find it's same. So here in this case, you see, if we look at today's detail, so in this right now, This is October month, so this will be your near month or current month. 25 of November will be your next month, and 30th December will be your far month. So for this Reliance, for who is which undervalue is underlying value of a security is 2622 and 30 paise. This is how you will get three stock futures: near month, current month, next month, and far month. Other terminology, underlying value. Basically, underlying value is the price of your asset. Like in our case is Reliance. So price of Reliance share in your NSC or on exchange will be your underlying price. Buyers of futures contract, basically by name itself, person who buys the future contracts known as buyer of future contract. And based on buyer's opinion, he may take you know type of contract. Similarly, seller, the person who sells future contract, because for any agreement you need two party, buyer and seller. Unless you have these two party, you won't find this kind of contract or this kind of instrument available. Other terminology that is that is used is open interest. So what does it mean by open interest? Basically, open interest is number of open contract or position on a given day. Or you can think of open position as number of buy plus sell side people are available. Let's say quantity, if you look at the quantity, if open interest is high, means you have these many options available in the market. It means if you want to go and trade at buy side or sell side, open interest will tell you. So it tells you basically how much liquidity is there. So basically your open interest increases when new contracts are added, and it could be added in both ways. It could be through no option from seller side or from buyer side. So you can think of people are standing who want to sell or who want to go for short or who want to go for long. So open interest, you see, open interest decreases when contracts are settled, when buyer is going to execute buy contract is going to execute, then you will find one here and one here, basically reduction of 2 unit in your open interest because it is squared off. And a very high open interest may indicate over levered market, because this is a kind of market sentiment. And why market sentiment? Because it tells what is the current. So one way it tells you about the liquidity, and second way it also tells you that if open interest is very high, that people are you know more positive towards the market, that whether if you want to go for going for buy option sorry buy side or sell side, you think there is someone available, but there may not be available. So that's why those situation we can call over levered market. So first what we are doing, we are discussing about these instruments, and then once you have better understanding of these terms or instrument, then easily you will be able to take you will be able to understand this market. Now coming to third type of contract or third type of instrument that we see in derivative market is options. So options means, so in previous to forward and futures, there was some kind of uh, you know uh, agreement between buyer and seller for exchange of goods with cash or whatever settlement was there. But sometimes you don't want to be settled, or you want some other way to make profit in the market. In that case, options are one of the tool that you can use. So basically, Options are contract between writer means basically seller, option writer or seller and buyer, which obligate the former and entities without obligation. Like in futures, what was the obligation? That when expiration date is coming, then both parties are going to honor that agreement, and then some kind of settlement will take place. But here settlement obligation is, and that's why without obligation. And the letter to buy sell stated asset as per the provision on the contract. And major type of options are stock option, like here instrument is stock, bond option, here instrument is debt instrument, currency option is instrument is currency, index option, futures options, even this is a combination, and options on swaps. So these type of options globally you will find, but certain option may not be available if you go and look at NSE or India. Why? Because it depends upon these tools, depends upon how much demand is there in the given market. So there could be two type of writer, it could be of two type, call or put. If you remember earlier, we talked about long position versus short position. Remember, these terms are very important. Unless you are able to distinguish, you will be getting confused. So when we say call or put, so what basically call option is? So when someone is buying call option, so basically call option will give buyer or the holder or the person who has purchased a right but not an obligation to buy. Remember. So in this, in call option, buyer will get a right to buy, right, but not an obligation to buy the underlying on or before specified time at a specified price. And the price at which it is going to be executed or it is going to be exchanged, if it happens, we call it strike price or exercise price. Here, if you remember in previous case, T is equal to T is equal to 0. We said that 100 rupee was per kg was the price that agreed that there will be exchange, and lot size was 100 kgs. Sorry, 100 kgs. So if it is executed, so T will become the strike price if buyer is executing option to take position of this asset, this kind of asset. So here he will be paying 100 into whatever 100 rupees, so 10,000 rupee for this lot size he will be paying. And to get this kind of contract, some kind of payment buyer will have to make. Remember, like when you, let's say when you want to buy some kind of land, some kind of payment would be required to ensure that it is making your agreement legal. It means you will have to make some kind of premium or some kind of payment to get this kind of right. Similarly, opposite to call, so here you are saying that you are getting a buy option, buy right, not an obligation. Similarly, put option means when you purchase, when you get put option, holder will get an option, not an obligation. Remember, to sell. He may sell or may not sell. It's up to the holder. For example, here you say, see that you got that, call option to purchase certain goods. But so let's say you have paid, for this, you have paid 200 rupees to get this contract to buy 100 kgs at 100 rupee per kg. So basically, if you go and exercise as T is equal to T, it will cost you how much? This 10,000, 10 into, 100 into 100 plus your amount that you are going to pay to buy this agreement or this kind of right option. But assume a case where after 6 months or here when your date comes, your price of pulses comes down to 80 rupee per kg. So if you buy here, so let's say 100 into 80, so it became 8,000 plus already 200 you have made. So in that case, if you see, so 8,000 minus 10,000, 2,000, you will be paying extra if you go and exercise. So what you will do, you will say, I won't exercise this, means I won't take position, I won't take delivery of this item. So in that case, what will happen? Only amount that you have paid for this agreement. So this is basically your call option premium. This much only you are going to sacrifice. Otherwise, your effective leave you will be sacrificing 2,000 additionally, assuming that this 200 is already there. So this option instrument gives you the benefit of minimizing your risk. And that's why I was saying that, when we talk about forward, futures and options, these give you variety of, tools, variety of options to minimize your or to hedge your risk. Similarly, call put, we already know what is call, what is put. Strike price, we already talked about. Strike price is price at which someone is going to exercise their right. Exercise means process by which agreement is going to be realized. Assignment is the process basically of by which seller of an option is notified that contract has been exercised, and expiration is the time at which an option can no longer be exercised. So after expiration, basically you won't be able to exercise, and that's why it is coined or term as expiration. So what we will do, we will stop our discussion here. So if you have any questions, so tomorrow we will complete our discussion on this, and also we will discuss about forex market, because this is very interesting area and where we can have lots of interest, especially when you want to take risk management or derivative market, derivative tools in your coming semesters. So that's why I'm going slow, so that whatever best way you can understand this market would be very much helpful. Because in terms of portfolio optimization, in terms of hedging, especially when you join any organization, financial organization or company, you will find they are using a lot these kind of tools to minimize their risk. And that's why it is important to spend time on all these terms and these topics. So, I'm stopping my discussion here. So if you have any question related to what we have covered today, I can take it. Otherwise, tomorrow we will try to complete this, as well as try to complete our discussion on forex market. Because once you understand derivative market, then forex market is not that much difficult because we won't go into the regulation because if you get into the regulation, then there are n number of sub-domains. Broadly, we will discuss about forex market, and then we will conclude our course with that topic. And next week, as we have already discussed, that we will start, I'll share your presentation schedule on your final assignment, group assignment, and there will be presentation in coming 2 weeks. So that in class, in the presence of everyone, I'll be able to evaluate your group performance in those assigned topics. Yeah, any question? Fine. So I believe there are no questions. So I'm concluding today's session. We will continue our discussion on this topic and forex market tomorrow. Yeah. Thank you.
Thank you, sir.
Thank you, sir.